it's like, yeah, just from Apple Maps. Hey, have you been there before? Yeah. Just want to meet here. Let's meet here. I just meet here like like 1:45. Yeah. Okay. Yeah, I'll just meet you there. So, or you can just come to my apartment too. Yeah, this is fine. Is it tomorrow? I thought it was Thursday.
Yeah, it is. Like stuff we learned.
I would say so. I don't know. I feel like she's gonna do like practice problems. Wait, oh yeah, that'll be like stuff on. She'll be like, oh yeah, that was like the problem we did.
Yeah.
Yeah, I don't know. Yeah, it's not good. I do a 10 would be. Yeah, I know. I got booked from 9 to a 10. I was like, let's go. I think I'm in the 11 right now. I'll take the 10. 73% there. I'm like, I can't look at that.
This is 5 minutes behind. Wednesday, it was.
Minutes. 10 minutes. So meet back here like 1:40. Yeah, 1:45. Actually, I'd probably put on shorts and a polo. I might wear pants. I'm not polo pants. I think I just wear khakis. Yeah.
You guys can preview.
I'll just meet you here. Yeah, that works.
Yeah, I did. When I checked this morning, it popped up more time, so
Actually did golf on Saturday.
Oh,
Yeah, but I didn't do much outside of that. I can go up to Boston maybe this weekend or in March. No, like now for St. Patty's Day. My parents went up to Boston. I just didn't go with because
oh,
it's kind of bad weather.
because so I think
I'll show you what I did.
when you screen share like this. All right,
That's like one of our
jamming,
farms.
guys. Okay. everyone.
That's at night. Okay.
I want to start with Beta Alpha Psi presentation on Wednesday is Advanced Excel. No matter what AI does, accountants will always use Excel. It's just the crutch we've grown up with and used. I use it all the time. I use it personally and all my stuff as well. I think I'm pretty advanced in it, and then when I see somebody who really knows how to do it, it's phenomenal what they can do with different tables and pivot tables and everything. So this Wednesday, this professor at the data analytics group is presenting on advanced Excel techniques. I think this would suit you very well no matter what business field you're going into. Being able to just master Excel would be a very good hour well spent. Okay. Apologize for the technology issue. Okay. So we are talking subpart F. We're going to finish that in a few minutes today, and then we're going to move on to our second anti-deferral regime. But remember, deferral, we're talking about the earnings of a foreign subsidiary owned by a U.S. corporation. Meaning we do not also tax those for U.S. purposes. As a general matter, that's the deferral concept. We don't tax it a second time, subject to these anti-deferral regimes. We're right in the middle of subpart F. Remember, subpart F is transaction focused. What type of income or transaction is that foreign subsidiary doing? If it runs afoul of one of the things we're talking about, then we have an exception to deferral. We are taxing it. This is an anti-deferral regime. Very old, decades old. So foreign-based company sales income is where we left it last time. And remember, this is your shorthand way. If you have personal property crossing two borders involving a related party on one side of the transaction, then you are going to have foreign-based company sales income. Okay? If it doesn't cross two borders, you don't have it. If it doesn't have a related party as part of the transaction, you don't have it. Okay? You need those two things. Okay. Does somebody volunteer for 513? Does anybody want 513? Go ahead.
Yeah, so in this case, we have USACO, a U.S. corporation that manufactures consumer goods for sale in Norway. Norwegian sales are made through Norco, a wholly owned Norwegian marketing subsidiary.
So let me pause you there. We're selling to Norwegian customers. It will always be allowed in the United States to have a Norwegian subsidiary in that transaction, right? That's where our customers are. Very natural to see that have a legal presence in the country in which you're doing sales to those customers, okay?
USACO also has a wholly owned Belgian subsidiary, Belco, that does not perform any functions with respect to manufacturing or sale of USACO's products.
You see facts like that, alarm bells go off. Is this a base company? It's not doing anything, right? And is somebody going to start trying to route a transaction through something that is not doing anything relative to manufacturing or sales? I.e., it doesn't belong from a tax code perspective in the supply chain. Okay?
If those are resells of goods to Norwegian customers, Norco does not earn foreign-based company sales income because their goods are sold within Norco's country.
So let's just test that in the bubble. Does it cross two borders? No. It goes from the United States to Norway. It never leaves Norway. It goes to Norwegian customers on the Norco chain of sales. Okay, so we do not have foreign-based company sales income. You move on from Norco's profit. It's not subject to subpart F. Okay, now you go to the next subsidiary.
In contrast, if Belco sells to Norwegian customers, Belco earns foreign-based company sales income because Belco neither manufactures the goods nor sells them for use in Belgium, and Belco purchases the goods from a related party.
Yeah, so it crosses two borders. It goes from U.S. to Belgium to Norway. And do I have a related party on both sides? Yes, I have USACO and Belco are related parties. Belco is not related to Norwegian customers because they're unrelated. And then the carve out that Anderson was mentioning, it does nothing with respect to manufacturer or sales. When we get to the next couple slides, you'll see there's an exception if it were to do some of those activities. Because again, then it's adding some value to the transaction. But here, you're just trying to route transactions through something, perhaps to try to carve some income off and have the tax at a lower rate than it otherwise would. Okay, so this is the exception I was talking about. Foreign-based company sales income. So if I do cross two borders and I have a related party on one side of the transaction, it is not implicated to the extent the foreign-based company is considered to manufacture the process. I put manufacturer in quotes. That's a subjective term, right? Think of what that could mean in a spectrum of full-blown that I could get everybody here to agree the best case scenario of manufacturing. Like you're taking raw products and you're building something. We all agree that's probably the most extreme. But then there's all kinds of other things that somebody could be doing, and at what point is it manufacturing or is it not? Is taking two parts and putting them together, is that manufacturing? Is bolting something together manufacturing? Is putting it in a package manufacturing? Okay? This has been a long, tortured history of debate between the U.S. government and taxpayers as to what is and what is not manufacturing. As you can expect, since this is an exception to foreign-based company sales income, taxpayers push the envelope as to what they say is manufacturing. The government wants to see more classical manufacturing. They've implemented regulatory tests to assess whether a base company is considered to manufacture. So we do have an objective safe harbor test. And that's meant by comparing the foreign-based company's conversion cost to that of the total costs. So you just compare how much are they doing versus the entire supply chain. If they meet that certain threshold, I forget what it is. It's a pretty low threshold. But then the government thinks, okay, they're doing manufacturing at that point in time. Absent that, then has the foreign-based company substantially transformed the product? In quotes again, we're in a subjective area. What something is substantially transformed to one person is different to another person. And then another subjective test, whether the foreign-based company has made a substantial contribution to the overall manufacturing of the product. Okay, so you can see this is a gray area. It's binary. If you're manufacturing, you're out of foreign-based company sales income. If Belco was a manufacturer, it's outside the rule, even though it crosses two borders in a related party. So you can see the debate coming as to what is manufacturing or not, because usually it's not this clean. Belco's doing something, maybe not as much as the government would like, and the taxpayer may be taking a position that they are manufacturing. Okay, so manufacturing exception, foreign-based company sales income. Okay, the last complexity here in foreign-based company sales income is branch rules. Okay, these are very complicated rules, and they are meant to address. We had the foreign-based company sales income rules, and taxpayers were getting very creative on how to avoid them. So the government said, okay, we're going to shut down that planning opportunity, and so branches were used, and we're talking branches of the foreign subsidiary. Okay? Attempt to close a potential loophole that could arise if the CFC's country of incorporation, so where the CFC is organized, does not tax income derived from sources outside of its country. Remember, most of the rest of the world does not tax income earned outside of their borders, the territorial regime. And the U.S. is the exception to that. And we got all the complicated foreign tax rate rules because of it. But most countries do not. So, in those countries, a CFC could avoid the rules we just talked about by selling personal property through its sales branch as opposed to a foreign subsidiary. So they choose to sell it through a branch instead of a foreign subsidiary located in a low-tax country. So they put the branch activity in a low-tax country because there would not be a foreign party sale. Because a sale from a corporation to its wholly owned branch is a nothing. Right? The branch is the extension of the corporation. So it's like me selling from right pocket to left pocket. That's not a taxable transaction. And if the country of organization of the foreign subsidiary doesn't tax that activity because it's outside the country, you have a chance to move income from that country to a low tax country. Okay? And not implicate the foreign-based company sales income rules. So the branch rules operate, and we'll go through examples here, to treat the branch as if it were a corporation. We don't make it a corporation for U.S. tax purposes. We just treat it as a corporation for purposes of applying the rules we just talked about. Cross two borders, related party on one side, does the entity manufacture or not? Okay? And that allows the foreign-based company sales income rules to apply, because if we treat it as a corporation, then we have the opportunity to test it under those tests that I was saying. Claude?
I'm assuming that in real life the lines can be blurred between the difference between a branch and a subsidiary. Does that happen?
No, not really, because a subsidiary, think of it, when I say subsidiary, it's a great point. When I say subsidiary, I mean a corporation. Okay? Like subsidiary and a corporation to me are exactly the same. It just means that one corporation owns that subsidiary, but it is a corporation. So you have to do some affirmative action. Whereas a branch is just, you start doing things in the country without a legal entity. You start selling. If that rises to the level of a business, then it's a branch operation, but it's not a separate legal entity. So I think the distinction is one requires an affirmative action to form the legal entity, the other one is just, you gotta start doing something, but you don't have to form a legal entity. Okay, now we do have this tax rate disparity, which adds complexity here. But what that rule is trying to do is saying, are you doing some tax planning here? And I'll show you how that works. So this was a major court case with Whirlpool. Whirlpool is the manufacturer. They're based in Chicago. They do washing machines and dishwashers and household appliances, right? And so they were doing this very planning, very creative planning. I was involved with it, a similar type of planning on several other U.S. companies that were doing something similar. And it was taking a very hard read of these rules, and the government didn't like it. They kept this case going. I mean, this case went on for years and years, and went to the highest levels of the government in court appeals. And I think the government eventually won on their assertion. And so all the taxpayers that had done this in the past had issues because the IRS then took that victory and went around and beat everybody on the head with it because, you know, don't fight me on this because I'm winning on this. And you had to change your structures to do this. Okay, so let's do an example here. So 517, this is Jerry. Brave soul, the branch rules.
Located in a territorial country that only taxes local source income, a CFC imports a product that the CFC subsequently exports. Assume the tax rate in the CFC's country of incorporation is 15%, and the CFC establishes a sales branch to assist with exports in another foreign country that has a 5% tax rate.
So that's important. The 15% compared to the 5% we'll come back to. That's where we're trying to look for indicia of tax planning. Like, is there a motivation to move income from a 15% tax jurisdiction to a 5% jurisdiction?
Because there is technically not a related party, there is not a related party transaction, and therefore not foreign-based company sales income unless the branch rule applies to treat the branch as a related subsidiary.
So let's think about our rules here. Our transaction flow is CFC buys product, sells through a branch, sales branch, who then sells to a customer. Did it cross two borders? Did I have a related party on either side? It might have crossed two borders if CFC was importing from outside of its country and then sold outside of its country. So I might have that, but do I have a related party sale? The answer would be no if F sales operation is a branch, because that is not a regarded transaction. It doesn't exist for U.S. tax purposes. So I'm outside the rule, So if that was the end result, then I accomplished what I couldn't have accomplished if it was a subsidiary corporation. So I got the tax benefit I was looking for, moving income out of CFC's country into F sales branch country, right? Okay, go ahead.
The branch rule applies due to the tax rate disparity test. 5% is less than 90% of 15%, 13.5%. 5% is at least 5 percentage points less than 15%.
Yeah, so the tax rate disparity is just an objective test of looking at the country, the CFC that owns the branch. Looks and compares its tax rate to the branch country's tax rate. You have to be 90% less, and then I like to think of it as 5 hard percentage points less. Both of those, then the antenna goes up for the US Treasury saying, I think you might have been trying to move somewhat higher taxable income to a lower tax jurisdiction. Okay? If the rates were flipped and CFC was 5% and the branch was 15%, you're not going to be in the tax rate disparity because you've moved income from a 5% jurisdiction to a 15% jurisdiction. Probably indicative that you're doing that for other than tax planning purposes, right? You're affirmatively paying more tax. I mean, there's some business reason why you're doing it. Okay.
Accordingly, the tax rate disparity test treats the sales branch as a subsidiary of the CFC, and income from sales made through the branch could be foreign-based company sales income because there is now a related party transaction.
So now I got to test whether I cross 2 borders, so I have to have an import and an export. I do have a related party sale, so I got the other part of the test that I need to be able to have foreign-based company sales income. Okay, so I just wanted to introduce this to you because this is the deep end of subpart F. Ongoing, decades-old disputes between U.S. multinationals and the government about, and it's all about trying to lower your foreign taxes, right? That's what a lot of international tax means. Okay, perfect, thank you. Okay, that's it for foreign-based company sales income. So we're looking for transaction flows, 2 borders, related party, and if I try to get cute and try to avoid the related party transaction, I got to test whether the branch would be treated as a corporation, and then make me test it under the foreign-based company sales income. Okay, so as you know, there's lots of different business models out there. It's not just sales transactions. There could be a service model where the particular client you're working on or the company that employs you is not moving tangible product. They are a service company. Okay, you could have a similar result as the sales company rules in a service model. So we're going to walk through that. So foreign-based company services income. First of all, services is extremely broad. So you cannot get cute by calling it a fee or by calling it a commission or something like that. If it's related to providing services, then the government will say that's in the rules. It's compensation services or other income derived from the performance of services, which you can imagine, power of the pen in favor of the government. They're going to create services very big, technical, managerial, engineering, architectural, scientific, skilled, industrial, commercial, and the like. Good luck trying to find a service they're not going to tell you is going to meet that, especially when they put it at the end. It's like any of those things. Okay? What you need is where both the CFC performs the services for or on behalf of a related person. Notice we always have these related party rules here. We need to influence transaction flow. So that's what the government's looking for. So first we have CFCs, controlled foreign corporations by U.S. shareholders. So that's an element of direction and control. And then related parties involved. Okay? So you need the CFC performs services for or on behalf of a related person and does so outside their country of incorporation. Just like that Norwegian example that we went through, where Norco selling to Norwegian customers is extremely logical, having a Norwegian subsidiary in the same country as your Norwegian customers. If you have a subsidiary that is performing services in its country, That's completely reasonable for a service company, right? You're gonna employ technicians or whatever, whoever's doing the services, and you have a customer-facing relationship in that country. That's not tax, that doesn't reek of tax planning, right? That's just normal business operations. But if you are servicing customers outside of your country, antennas go up. Are you trying to like move income out of that country to a low tax country? Then we might want to tax that currently under the anti-deferral rules. That's where we're headed on services income. It effectively limits deferral for services income of a CFC that was separated. I like to think of it as hived off, but it was kind of like taken away, separated from related manufacturing and sales activities. Because the idea behind these rules is your manufacturing country and your sales country are probably driven by business reasons, right? Tax is not gonna dictate where you manufacture something necessarily or where you sell something. That's gonna be business driven 9 times out of 10, right? And so this is saying, given that fact pattern, have you went in from a tax planning and you're trying to just take off some of that income and move it somewhere else where it's lightly taxed? And if it's lightly taxed, the U.S. says, oh, I'll tax it under subpart F as a current conclusion. Okay, services income 518 is Sydney.
USA Co., a U.S. corporation, owns 100% of a German corporation. USA Co. is in the business of manufacturing drill presses for industrial use. USA Co. sells drill presses to both French and German customers. A condition of these sales is that USA Co. will install and provide maintenance services with respect to the drill presses. Durco performs these services on USA Co.'s behalf in both France and Germany. The fees that Durco receives for services performed in Germany are not foreign-based company services income.
Why? Because they're doing this for German customers. So if they are doing, for services performed in Germany, that's where we have the classical. You're always going to be able to set up a foreign subsidiary in the country in which you're doing the services. That doesn't reek of tax planning, right? So that is not subpart F. That is going to be the general rule of deferral. So we get to our second topic of today. Okay.
So in contrast, the fees that Durco receives for services performed in France are foreign-based company services income because Durco employees perform the services outside the CFC's country of incorporation on behalf of a related party.
So that's our only 2 tests. Did you perform services for and behalf of a related party? Yes, I'm doing this on behalf of the U.S. company. Did you do them outside of your country of organization? If I'm traveling to France and doing that, I'm not doing it in Germany, I have the potential for foreign-based company services income. Okay? So I think here, until if you ever practice in the international space, you'll get attuned to smoking these kind of fact patterns out, but you just gotta commit to memory those shorthand things, the requirements, crossing borders for the foreign-based company sales income, and then this for on behalf of a related party outside your country of incorporation. And then just go CFC by CFC. What transactions is it involved in? Because subpart F is looking at specific transactions. Okay, so we have some special rules. So there are 2 administrative rules. I just want you to be aware of this if you hear people talking about it. One is the de minimis rule. So remember, subpart F is going in and looking at certain transactions. You could have 1,000 transactions that are not subpart F, right? You're doing everything in your country. That prior example, 99% of your business is servicing German customers. Not subpart F, that 1% in France is. The de minimis rule is just a rounding administrative convenience. It says if your subpart F income is so small relative to your total income, we'll treat you as having no subpart F income. Meaning the government doesn't want to bother chasing every last nickel. Okay? That prior example, if the German business is so big, France is really small, government says, let's just forget about it, subpart F. I don't think you're doing that because of to save nickels on tax planning, I can't deal with that. Conversely, we have a full inclusion rule, which means if you're doing so much subpart F activity and a little non-subpart F, we're going to treat it all as subpart F. So going back to this example again, if 99% of the business is French customers, 1% is Germany, then the German part of the business gets swept into the subpart F inclusion. I just view them as rounding. The government rounds down if it's small, rounds up if it's so big it's just all of it, instead of getting too precise. So that's the administrative convenience rules, if you will. There is a high tax election. Okay, the high tax election is available whereby CFC's collective subpart F income. Remember, we started with foreign personal holding company income. This guy. And that was your passive income flows, foreign-based company sales income, foreign-based company services income. You can nonetheless exclude those from current inclusion in the United States if that income is subject to a high rate of foreign tax. The way we measure whether it's a high rate of foreign tax is 90% of the highest U.S. tax rate for corporations. So 90% of the 21% corporate tax rate is 18.9. So if you are subject to foreign tax of at least 18.9% on your subpart F income, you can elect to exclude that. Why? Because the government is saying, the US government is saying, you're not doing any tax planning. And we have a German colleague with us. If I move income from France to Germany in this example, Germany's taxing it. They're not doing anything, not saving anything here. And these are two high tax jurisdictions, Germany and France. I'm not doing anything. Whereas, remember that prior example we left last week with, it was Keiko. We were doing transactions and we had Cayman Islands trying to capture some income. That's where that's a low tax country. That's the classic that we're trying to get to. You're not doing foreign-based company sales income to move income into Germany or France or India. It's like, you're just paying foreign tax. It doesn't. The U.S. is not saying that's subpart F income because it's too highly taxed. We're looking for low tax, portable income under subpart. We can make an election to exclude the high tax earnings. And so, in example 518, this foreign-based company services income for Germany for servicing the French customers, it's going to be subject to German tax. You can't have a German corporation earning fees and not pay German tax. And it's going to be a relatively high rate of tax. So you can elect the high tax exception, which would pull this income out of subpart F. If this was a Cayman company, you would not be able to make the high tax election because it's not going to be 18.9%, 90% of 21. Okay. We do get a foreign tax credit, right? We are currently including foreign income in the U.S. tax return, and if it's foreign income, it might be subject to foreign tax. So the government, again, is trying to alleviate double taxation of those earnings. So we do get foreign tax credits are allowed for subpart F income to mitigate double taxation of the subpart F income. The first is the host country which you're doing this stuff. You're likely paying foreign tax. Again, these are transactions or income streams received in a foreign country. Liable to pay foreign tax there. Now, you might not be paying much because you might be at a very low tax rate because of your tax planning. But if the U.S. doesn't give you a foreign tax credit, even that little amount of foreign tax you're paying, that has caused you to have double tax. Okay? So the requirements are the U.S. corporation owns 10% of the voting power of the CFC, generating the subpart F income, is allowed an FTC for the underlying foreign tax on those earnings. The reason we call these deemed paid, okay, this took me a while to understand why are they calling the foreign tax credit in this instance deemed paid? Because the foreign tax is actually assessed on the foreign subsidiary, right? It's the one doing the business. The buying and the selling or the services income or the receipt of the passive income on the foreign personal holding company inside. So the only reason it's deemed paid is because we are allowing the U.S. company who is including the subpart F income a foreign tax credit on those foreign taxes that it itself did not pay. But since we're including the income, we're going to deem the U.S. company to have paid the foreign tax. That's why you hear people call it a deemed paid credit. You're presumed to have paid the tax because you're presumed to include the income. That's the thought process. Okay, let's do an example of that. 525. You may want 525. What? Sign for it?
So 525. USA Co., the USC Corporation, owns 100% of the shares of Asia Co.
So right off the bat, we know it's a CFC, right? Because it owns, we have a U.S. shareholder, a U.S. corporation owns greater than 50%, so it's a CFC.
Foreign corporation. During its first year of existence, Asia Co. earned $10 million of subpart F income, paid $2 million in foreign income tax, and did not distribute any dividends.
Because again, we're talking about deferral and anti-deferral, right? If they made a distribution, then we're already taxing the income. So the idea is they didn't make a distribution. The question is, does the U.S. keep their hands off of taxing that income that was not distributed, or does it run afoul of these rules we were talking about? Okay.
Because Asia Co. is a CFC, USA Co. must include in income Asia Co.'s net subpart F income, which is $8 million. That is $10 million of subpart F income, less $2 million of foreign income tax. The inclusion of subpart F income carries with it deemed paid foreign tax credit of $2 million. That is Asia Co.'s foreign income taxes of $2 million times $8 million subpart F inclusion divided by $8 million of earnings and profit. With the $2 million gross up, USA Co. has $10 million of income and $2 million of deemed paid foreign tax.
So let's talk about this. So the net income is 8, right? It had 10 million of subpart F, but it paid foreign tax of 2, so its net income is 8. When they talk about gross up, the whole concept of the gross up is if my inclusion was only 8 million, then what have I done? I've effectively deducted the foreign tax, right? Because I gave you you made 10 million of income, but I reduced it by the foreign tax of 2 to get to 8. So I can't give you, right, remember when we talked about foreign tax credits, you can't take a deduction and a credit for the same tax. One or the other. So if you want to claim a credit, then you have to gross up the net income to pre-tax income. So your inclusion is actually 10. It's your pre-foreign tax income. Then I can tax that and run it through our foreign tax credit limitation calculation that you guys will know so well. And then I can assess whether I can credit the 2 million. But if I only taxed 8 by virtue of giving a deduction for 2 of foreign tax, I can't come around and try to claim a credit for 2. Then I've double counted the same foreign tax. That's the concept of the gross up. And it's a weird term, but everybody calls it the gross up. It's just trying to get the foreign inclusion back to pre-tax foreign income so that I can claim a credit and not a deduction as well. Okay, do that last part for us.
The U.S. shareholder allocates an inclusion of subpart F income between the separate limitations of income. And the note here saying regarding the limitations that what Professor Pamiga spoke about, basketing for FTC limitation purposes requires looking through the nature of the CFC's earnings, giving rise to the subpart income, as subpart is not one of the 4 current baskets.
Yeah, so remember when we did our FTC limitations and the baskets, we do 4 categories of baskets of income that we do a limitation on. Subpart F is not one of them. It was passive income, it was guilty, it was the third one and the general one. But you have 4 baskets. Subpart F is not one of those 4. So what you have to do is look at the CFC, the income, what was it created from? And then I put the income that I'm including in the basket based on the type of income that was generated by the CFC. That's that plan. Okay.
Between the separate limitation of income based on the nature of CFC's current year income, that results in the subpart F.
So if it's a buying and selling transaction, because it's foreign-based company sales income, that's probably going to be general limitation. It'll probably be that fourth basket because it won't be caught in any of the other. Okay. So the last substantive topic in subpart F. So if we tax undistributed earnings of a CFC, what happens when the CFC then distributes those earnings in a future year? Okay? If I receive that as a dividend in the future year, dividend income is taxable income. It goes into gross income in taxation of business entities, or if you are taking it, dividend income is always gross income. So, isn't that double taxation? The way the government deals with that is we create what is called PTAP, which is previously taxed earnings and profits. So, when we have subpart F income in any of the transactions we've talked about, the U.S. currently includes it, but it's undistributed. We tag that income at the CFC that has not yet been distributed as previously taxed for U.S. tax purposes. What that means is when it is subsequently distributed, it comes out first, and we do not tax it again. Previously taxed earnings that are then subsequently distributed are not gross income for U.S. tax purposes, right? Because we already taxed them. This is the way the government makes sure you don't get double taxed. So if you wait 10 years when you created the subpart F income before you make a distribution, that first distribution in year 10 comes out of the PTAP account, the previously taxed earnings account. Okay? This is a very big issue right now because the government's writing new PTAP regulations, and taxpayers are always focused on those PTAP regulations. Yeah, George.
Yeah, so it looks like it's kind of like complex. So I'm wondering who keeps all these reports.
Okay.
Transparency.
Okay. So information reporting. Okay. This is very specific, right? How does the government get this information? Especially you got hundreds of CFCs, 50 different countries, all of these things. Like, how do you possibly keep track of all this? Well, hire good young professionals such as yourselves to help companies do this. So this is where complexity is not a bad thing, right? Job security, we don't want it too simple. And the U.S. tax code is never going to get too simple, I don't believe, not in my lifetime, yours either. So lots of information reporting has to go on. You have to make sure you get the information from the foreign subsidiaries, keep it in a manageable form, and then report it annually to the U.S. government on your annual tax return. Form 1120 is the U.S. corporate tax return. Form 5471 is the key form. If you work in the international space for any U.S. multinational, you will become experts in Form 5471. That's what tracks all this stuff. And it's pages and pages, and there's one for each CFC. You could have tax returns that, back when people did physical tax returns, they could be foot tall of these things. Very, very complicated, but this is the only way the government can track this stuff and make sure you're treating it correctly. And so things that are reported are such things as your share ownership, including acquisitions and disposition of shares during the year. Why? Because they got to determine who's a CFC. How many shares do you own? Are you a U.S. person? We know that that's the test to get you to CFC status, right? The identity of the U.S. shareholders. You got to know who's the U.S. shareholders. These are the ones that are supposed to be including this stuff. We want to see your GAAP income statement and balance sheet of the foreign subsidiaries. We want to see your foreign income taxes paid, your share of subpart F income, and then the transactions. This is the important part. The transactions between the CFC and its U.S. shareholders and other related parties. They make you spike out from your income statement which ones are related from U.S. transactions and which ones are from between CFCs. And that's where, if you do this over enough years, you can create a form that will smoke out the transactions we just studied. Your services income coming from a related party, right? Maybe I'll ask questions about that. Are you doing sales through related parties? Maybe I'll ask questions about that. But this is, you're self-reporting as the company, so you have to do this. Who's gonna look at that? Two entities are gonna look at your reporting. Your audit firm is probably gonna be the most educated, deepest bench looking at that. But if if you're a multinational and your audit firm is also a multinational, they will have experts on this. So you might not just be doing this for your particular company or your client, you might be auditing this on an audit client. Are they reporting Subpart F correctly? Have they identified all the transactions? Have they done the calculations correctly? All that stuff has to be assessed for purposes of giving your audit opinion on the tax return. You might be involved in that at an audit firm. Otherwise, you might be at the company doing this and you have to be compliant, self-reporting. Or you might be defending a client or a company from the IRS, the government, asking questions about all of this. So, yes, long-winded way of answering your question. It's very complicated, lots of transaction reporting. It's just the mechanism our government has chosen to look at things for international planning. How somebody like me could work in the area for 2.5 decades. Okay. All right, now we're shifting gears. That's Subpart F. Okay. Long-standing transaction focus. That is important to keep in mind. You're either in or out based on the types of transaction that you're doing. Now we greatly expand the scope of anti-deferral to where it's almost now swallowing up the general rule of deferral. This is the GILTI regime. This was Trump 1.0, 2017 Tax Cuts and Jobs Act, introduced brand new regime, the GILTI regime. The drafters of this stuff were trying to be cute, in my opinion, with the naming, with the acronyms. So they chose the words of the regime to fit a nice little trendy acronym. The idea here is I wanted something called GILTI, even though it's misspelled. It's not, that's not how you spell guilty, right? But that's what people refer to it as is GILTI, and they knew they would. But it's effectively global, intangible, low taxed income. So it is descriptive of the test we're going to go through. We're going to be focusing on intangible income and low taxed income. The idea behind this was twofold. What happened in the Tax Cuts and Jobs Act? We took the headline U.S. corporate tax rate from 35 to 21. Massive reduction. Good thing for business. But they had to pay for that, right? One of the ways they paid for that is with this regime. The second reason, not just to pay for, is there was a perception, right? Think of this was the Republicans in charge in 2017 when they drafted this legislation, is that we want to build in America, we want to incentivize you to create U.S. jobs, U.S. investment, and we think, corporate America, you've done too much to move income offshore into your foreign operations via where you put your intangible asset returns. And you've been very smart over the years, because Subpart F's been around, where you've navigated those existing rules we just spent the last sessions going through. So we want to have a second hurdle that you have to go through. I'm still going to catch you if you have one of the Subpart F transactions, but if you get through Subpart F, now you have to go through GILTI. That was the watershed moment for taxpayers with the Tax Cuts and Jobs Act. Okay? Lots of new work, lots of consternation as to how these rules work. If I haven't mentioned it already, they negotiated the Tax Cuts and Jobs Act. They created the Tax Cuts and Jobs Act in 6 weeks. That's extremely fast for a massive piece of legislation like this. And when I put it in quotes, because there was not one Democratic voted congressman or senator voted for this. So it was completely Republican because they had control. They wanted to get it through. And going that fast, you're going to have issues with the legislation. Because it's this business is too complicated, there's too many other rules out there. And again, we don't ever tear things down, we just add things on. So you just added a big giant thing on there and you just ran roughshod in getting it through because you had the votes. And so the taxpayers have spent the last, 7+ years working through this legislation and how it impacts them. Okay? So we are trying to disincentivize moving intangibles offshore, meaning that if you do move them offshore, we're going to tax you on them at return. And it's to prevent the avoidance of U.S. taxes on non-routine operating earnings. I'm going to talk in terms of routine and non-routine as a proxy of how do we get to intangible income. Okay? The reason I want you to learn this is because this regime is in place for last year. So corporations haven't even started doing their tax returns for 2025. If you go to work in one of these organizations, you might be involved in that effort. So you got to know these rules. The other reason is because the U.S. has a lagging audit schedule from the IRS. So even years from now, you might be auditing, answering questions about an IRS audit in these years. Not guilty. So I don't think you can just throw it away and then go to the new regime that we're going to start on Wednesday. But so you're in this kind of nice area where you got to learn the old and learn the new. The good thing is the new builds off of this and they just tweaked it. Why? Because corporate America made their voice heard over the last 7 years. That you rush this legislation through and here's what it's doing actually in practice. And they got that pushed through those changes in the One Big Beautiful Bill Act last year. Okay. So as a big picture, the guilty regime assumes, okay, so they don't directly find intangible income. They assume the income of a CFC in excess of a 10% return on tangible assets is your intangible income. Right? Just like we were just talking about, we could all differ and that different taxpayers can differ as to what constitutes manufacturing and what doesn't. If we started instead debating what is intangible income versus what is not, it's a very subjective measure, right? And you're going to be in endless debates with taxpayers and corporations and in court arguing over what is intangible income and what is not. So the government said, I am not going to go down that subjective argument with you. I am just going to say, I'm going to look at your tangible assets and I'm going to give you a 10% return on your tangible assets. Anything you're making above that has to be intangible. Now you can debate whether 10% is on tangible assets is the right measure, but that's the law. That's what they wrote. So they went for an objective measure, rough measure of what is and is not intangible assets. So we are looking for CFCs that have a greater than 10% return on their tangible assets, and that's what is going to be the subject of the guilty regime. You can automatically, if you compare this regime to Subpart F, Subpart F is focused on certain transactions. Did I mention anything here about certain transactions? No, we're just looking for outsized, non-routine returns. If you're making a lot of money relative to your tangible assets, you're going to create guilty income. And the government's not focused on how it got there and how your transaction flows. They're just looking at the CFC's earnings. That was a big change from what corporate America was used to in Subpart F. Okay, in the bubble here, the guilty provisions are designed to impose a minimum residual U.S. tax on a CFC's high return, i.e. intangible assets or intangible income, low tax foreign earnings. Remember, it's intangible, low tax. If you want to put I'll pick on Germany. If you want to put your intangible high earning, high return income flows into Germany, the U.S. is saying, have at it. You're going to pay tax to Germany like crazy. You're not doing anything from a tax planning perspective. Now, if you start trying to put that in the Cayman Islands, and you're not caught under Subpart F, then you are caught under guilty. Because you have low tax and tangible income, because you're not going to have many tangible assets in the Cayman Islands. Okay, so that's the structure that you need to think through. First, you go through the subpart F, but now we got this big old giant conclusion that is starting to now swallow up the general rule of deferral. Nearly everything's returned, and nearly everything's included. Okay, so they start borrowing terms as well, so we're only dealing with CFCs again. Again, we like that control element. It's got to be a foreign corporation, and it's the same test that we did under subpart F. Remember, we did all those different examples. Identify your U.S. shareholders, which are greater than 10% owners. Collectively, they have to be greater than 50. If I don't have that, I'm not subject to guilty on any of my foreign subsidiaries. So, same paradigm or same fact profile of CFCs that are foreign corporations that I'm looking for. And the guilty regime, the best way you can navigate it is just pound through defined terms. You started defining terms, right? The guilty acronym, they got fancy with that. They're going to start defining terms, getting to what your inclusion is. So you have to just understand what the required terminology means. And to compute the amount of guilty generated by a CFC, we're going to be looking for net tested income. That's the terms used in the legislation. And the net deemed tangible asset return. That last part is the 10% on tangible assets. And you can imagine what we're going to do. What's your net tested income? That's your total income. What is from your tangible assets? Guess what? Everything else is intangible. That's what this regime does. Okay, so tested income, just to be specific, is the income of the CFC. It does exclude some items, and it does allow a reduction for allocable expenses. Okay. Subpart F, I put this in order, and we covered them in order. If it's already included under Subpart F, you don't test that income stream again. It's already included. Okay. So guilty excludes net tested income, I should say, excludes Subpart F income. It's already included. You don't need to go there again, right? And foreign tax is an allocable expense in arriving at tested income. So if this is the same thing we talked about in that that example, I think Claude did. The example where we had a gross up. So if a U.S. shareholder seeks to claim an FTC, so you can imagine we're going in and we're trying to isolate this intangible income. Well, it's likely taxed in the foreign country as well. It might be low taxed, but it's not zero taxed in most instances. Most people don't try to put this stuff in tax havens. So if it's 5% tax and it's going to be included in the United States, if we want to claim a credit, then we got to deal with that gross up situation that I went through with Claude. So that requires the foreign tax to be added back to tested income, commonly referred to as the gross up mechanic, to arrive at pre-tax tested income. If you're trying to claim a credit for any of your foreign tax on your inclusion. If not, then you effectively are taking a deduction for the tax and trying to claim a credit, which is a no-no. You can't take credit and a deduction in for the same tax, right? Double count. Okay. Very similar in concept to the exception from Subpart F. Highly taxed operating earnings, greater than 90% of 21%. Same rule, 18.9%. Can be excluded from tested income, although the exception works a little bit differently from Subpart F, and I'm not going to drag you through those details. But again, it makes sense. If you have high intangible income, but it's already being taxed higher than 18.9%, the U.S. is like, well, it's not low tax, and low tax is in the guilty name, right? So you can exclude that high taxed income. And the tested income of a CFC is netted with a tested loss of another CFC in determining whether the taxpayer has a net tested income. This is on an aggregate basis. So the government looks around the world, all of your CFCs, let's get you your net tested income. As you know, not everything's income. Some things lose money, just the way it is, right? Pandemic times, we have lots of CFCs that lost money. So I get to net losses against income and arriving at net tested income, which is the first term we want to try to isolate. If we have an example of that, did somebody sign up for yes, Genevieve? Genevieve not here? Okay. George, you're Genevieve, but you can put your name down. Come on. You get credit for doing that. Just change your name on it.
Yes.
US Co. Owns CF1, which earns $10 million of tested income, and CF2, which has a $5 million tested loss. Accordingly, US Co. nets the $10 million of tested income from CF1 against the $5 million dollar tested loss of CF2 to derive net CFC tested income. $5 million.
So it's just saying I do get an offset. Right, so this is important. The U.S. could have written the rule where I just look at CFC1 and include 10 million, but they do allow a global offset of losses in income. This is different than subpart F, right? Subpart F is going in and looking at each individual transaction and trying to spike that out for inclusion. But this is a CFC broad test, so I do get the net. Okay, thank you. So the second item that I need to so my first was net tested income, and that's an after tax, and I get to add everybody together. The next one I want to get to is the net deemed tangible income return. Okay, lots of terminology, but I think if you just look at what the words are trying to look at, it's a deemed tangible income return. We're deeming it to happen because we are not going to get into a debate on each one of your CFCs as to what's tangible income and what's intangible. Okay. So, deemed tangible income return, as I mentioned, is that 10% return on your tangible assets, what the government calls qualified business asset investment. That's the definition, but think of it as their tangible assets used in the business. Machinery, equipment, warehouse, that type of computers, all those types of things that are tangible assets. We're just going to flat out say, get 10% return on that. It's what we would expect tangible asset to return in value. What you'll see here, intangible property does not count as qualified business asset investment, which everybody calls QBI. And you hear everybody talking in these terms, so it's like a new language that's out there. But intangible assets are not QBI because we're trying to hone in on what are tangible assets. And the way we do that is we look quarterly average of tangible asset balances. So we're looking at your tangible assets by quarter, and then we average them over 4. And that's going to be your QBI in that particular entity. And it does not, importantly, the QBI does not include the tangible property of CFC with a tested loss. So although we get to net the tested loss with tested income, in the example that George went through, we do not get to take the tangible asset return in the lost CFC into account. And that's one of the complaints that corporate America had, is that seemed inappropriate. So the deemed tangible asset return is reduced by the net interest expense of CFCs. So if you have interest expense in your CFC, meaning that they borrowed money, then that is reduces your deemed tangible income return. It's premised on the belief that tangible assets should not be debt financed. Okay? So the government's going to make you reduce your tangible income return if you have debt in your CFC by the interest expense. QBI in the bubble is the key factor in distinguishing the routine return of a CFC. Okay. How much tangible asset do you have in there? The bigger the amount of QBI, the bigger your 10% return is, that gets hived off your net tested income. It's not included. Okay. show that in this example. Anybody volunteer for B?
I did.
There.
Yeah.
USCO owns a CFC which earns 10 million of tested income and owns 15 million of tangible property. Holding tangible property subject to depreciation for use in the production of tested income, the CFC has specified tangible property of 15 million, which is also the amount of USCO's QBAI.
Yes, so that's what we're honing in for, and we're gonna give a deemed return on that asset, right? So importantly, it's not intangible assets, and this is a tested income CFC, so we get to count it, okay, in this calculation, okay? Thank you. C is,
Yeah, I just signed up for it today. Basically, USCO owns. USCO owns CFC1, which earns 10 million of tested income and owns $15 million of tangible property. And CFC2, which incurs a $5 million tested loss and owns $10 million of tangible property. Because CFC2 is a tested loss CFC, the 10 million of tangible property is not included in the QBAI.
you guys don't wanna say QBI.
Oh, QBI.
It's okay, you gotta get in the lingo, QBI.
As a result, the only QBI is the $15 million of tangible property from CFC1. Because only $1 of tested income would result in CFC2 being a tested income. CFC, whose $10 million of tangible property would count towards USCO's QBI. The USCO group may aggressively try to use transfer pricing principles to move just over $5 million of income from either USCO or CFC1 to CFC2.
So we're gonna get to a comprehensive example in a moment. So this is building off before I had two CFCs, one had income, one had loss. I get to net the income and the loss, but I don't get to count the lost CFC's tangible property in the calculation. And why is that important? Because I get a 10% return on that is not gonna be included in the GILTI regime. Okay, so that last part that you mentioned is, well, if I could work hard over the next year and get CFC2 positive by $1, it doesn't have to be any amount, it just has to be income. Just $1 of income in the most extreme example counts all of its tangible property in the calculation, which is beneficial for the taxpayer. Okay. Okay. D is Katie.
So USCO is in the music publishing business and owns European CFC. CFC has printing machinery with an adjusted basis of $8 million and purchases the music rights to the latest hot European rocker for $4 million. Because these music rights are intangible and not depreciable, they're not included in the QBI. Accordingly, USCO has QBI of only $8 million.
So that's just illustrating that carve out, right? We don't go in and look and see, okay, that intent. You could have written, if you were drafting this back in 2017, you could have said, I want to go in and say, music rights are intangible. What type of income is generated on that property? And that's what I'm interested in. That's not the path that the drafters went through. They didn't go down through that. They just wanted to hone in on tangible property, give a deemed return. Everything else has to be intangible. Okay, again, they try to make it objective instead of debating what's the return. Identifying and then analyzing what the return is on actual intangible asset. So you pull the intangible assets out of your QBI calculation. Okay, so the calculation of the GILTI inclusion. So once you have net tested income, which is you got to go by all the CFCs and you get the net your losses with your income, and you know your deemed tangible asset return, which is what are all my tangible assets that are available, and I give it a 10% return. The U.S. shareholder can determine its GILTI inclusion. All you do is you simply subtract the latter from the former. Give them a rough proxy for what we think is a tangible return. We know your total return. The delta is intangible return under this mechanic. Okay? And you do this on an aggregate basis throwing all your CFCs into the calculation. And like the subpart F regime, since we are taxing undistributed earnings, right, this is an anti-deferral regime. The earnings have stayed in the CFC, then subsequent distributions are of income previously taxed is not subject to GILTI. Again, same thing as the subpart F income. My hypothetical there, I have creation of subpart F income, I have a creation of GILTI income in year 1, and I make a distribution of that in year 10. That distribution in year 10 is not dividend income subject to inclusion as gross income. It's already been taxed. Okay. Same mechanic as subpart. Okay, a couple more examples here. E is Eugene. Come on.
We see that USACO owns a CFC that owns tangible property of $15 million, earns tested income of $10 million, and earns interest income of $1 million. The deemed tangible income return is $1.5 million, which is 10% of the $15 million of the key buy of the CFC.
So we've identified the tangible property. We give a 10% return on that, no matter what it actually generates. So that's 1.5, so that reduces our net tested income and is our rough proxy for a deemed intangible.
So because there's not a net interest expense calculation, it ignores the $1 million interest income, and accordingly, the net deemed tangible income return is the same as the deemed tangible income return of the $1.5 million. The GILTI is $8.5 million based on the $10 million of tested income less the $1.5 million of
Yep. So we get to reduce it for that. That's why when I don't get to count that Q buy in my loss corporations, then I don't get as big a number as I would like, right? That's one of the complaints in this piece of legislation, is you're artificially keeping that number low. Okay, example F, anybody want F? I'll do F. USCO owns 2 CFCs, 1 and 2. One owns tangible property of 15, that is CFC 1, and CFC and earns interest income of $1 million and has tested income of $10 million. So I just have to go through each one of these and identify those defined terms. If I start trying to do a GILTI question without going in, honing in on the defined terms, I'm not going to be able to solve that particular question. Okay, CFC 2 is a tested loss CFC, 5 million loss, owns tangible property of 10 million, incurs tested loss of 5 million, and incurs interest expense of 2. The net CFC tested income is 5 million because I take the 15 and the 10, so that's my 5 aggregate at the shareholder level. And the deemed tangible income return is 1.5 million because I only get to count the 10 million of tangible property in the income CFC 1. 10 million times, 15 million, tangible property 15 million times the 10% is 1.5, right? That's my deemed tangible return. And so that is going to get me down to 1.5, 10%. 10 million of tangible property so the 10 million of tangible property in CFC 2 does not count. It's a lost CFC. And I'm going to have you skip the middle part because that's just way too complex for our purposes here. So focusing down on the bottom, the net deemed tangible income return of 1.5, the GILTI of 3.5 is comprised of 5 million of net tested income, 15 million and a 10 million loss, so I have 5 million, and I get a 1.5 deemed tangible return on my buy, and that's going to leave me with a 3.5 inclusion. Okay, this represents the compilations of examples A through E. We just built on all of it and then did it all at the end. I just like looking at the individual components because it's hard to go straight to the end result and do the calculation. Okay? So you just have to master the terminology here and go through. through these, I thought. Okay, you do get a deemed paid credit, and it's always because, right, this income that we're honing in on is going to be subject to some level of tax in the host country. Okay, so you do get a deemed paid credit, and it is allowed for in the U.S. and it's mitigated by a credit for U.S. taxpayers, and it must be allocated. So what we have to do here is allocate the foreign tax between what is included and what is not included. If you think of non-routine earnings, the intangible return was included. Well, I do get normal routine earnings. That's the assets. I have to bifurcate my total foreign tax between those two income buckets, and I only get the portion that goes to the amount that's included, right? Because the foreign country, the host country, is going to tax all the income, right? And GILTI does comprise one of the FTC limitations. When we were in the FTC world, it was the second bucket. We had passive basket, we had the GILTI basket. So all my GILTI credits go in that basket. I do an FTC calculation to see how much I can utilize. Okay? It requires a separate FTC limitation, which is negatively affected by U.S. shareholder apportionment. This is the key fact. They changed this in the One Big Beautiful Bill Act. Remember when we do the FTC limitation, I have to apportion expenses against that income stream. I had to apportion my U.S. expenses against my GILTI inclusion. And that caused a lot of multinationals to have excess credits in their GILTI basket. Chronic excess FTCs in their GILTI basket. Chronic FTC, that's double taxation. Okay. They largely solved that, and we'll do that on Wednesday. Okay. Interestingly, for GILTI inclusions, the U.S. shareholder can only credit 80% of their foreign tax with their inclusion. So if you paid $100 of foreign tax, you only get $80 of eligible foreign taxes to credit. You still have to do your limitation, but they haircut the amount of foreign tax that you actually pay down to what they're going to allow you to pursue as a foreign tax credit through the limitation. The idea was we want taxpayers to be focused on paying the least amount of foreign tax. If I give you 100%, if I allow 100% of your foreign taxes to be eligible for a credit, you might become lazy in assessing the right amount of foreign tax you owe. Right? Because if you pay foreign tax and you get a credit against your U.S. tax, you might be like, well, if I get a credit, I don't care who I pay it to, because it's going to be offset. I either pay foreign tax or I pay U.S. tax. I'm really indifferent. I pay the same amount of total tax. So by lowering it down to 80, I'm going to be really, really focused on paying the least amount of foreign tax possible. That's the idea. Again, another issue that multinationals did not like, and you'll see how this changes with the regime we're going to talk about from the One Big Beautiful Bill Act. Okay, we'll pick up here. I don't want to rush through any of this. And then what we're going to really spend our time on the rest of this chapter is what changed in the One Big Beautiful Bill. And so we'll compare GILTI with what is now in effect 26 forward. And it's not a total rewrite. It's just tweaking the things from GILTI. So if you understand the GILTI regime, you're going to understand the regime prospectively that starts in 26 for taxpayers, because they didn't actually rewrite anything. They just turned the dials. Okay? All right, so we will finish chapter 5 on Wednesday, and then we're going to go to, we only have 2 weeks left of class. Then we're going to go, which means that we have a final. And then we're going to go into the remaining classes after we finish the new regime is going to be on inbound topics. We covered all the outbound topics. Okay, thank you.
Is it the sign-in sheet?
Yeah, sign-in sheet. So I got that one. Okay.
Oh, this is